Now, of course, as an investor, you say my return is at risk. There's more risk, so my risk-adjusted return is getting worse. But if you've got nothing else, then that's it. I mean, that's what it is. But another big change with this major change of cycle we're in now is that you now have alternatives for the first time in a long time, in decades. You have alternatives to US assets. Let's review that briefly. That leads to the views we have in the portfolios, and we try to take a look at the positions we now have in portfolios on the back of all these scenarios you've seen, to try and cover all the cases with the probability we discussed with Babak. There are alternatives, and a simple way to look at this is to look back at the efficient frontier. So I don't want to be too academic there. Keep it very simple. On the pattern for investors, what you had to start with, like back 10 years ago, 13 years ago, was rates at zero everywhere. These were the assets for US investors. You had a better return on treasuries, on credit, on the S&P, with a risk that increases the further you go. Now, when you have low rates, of course, that makes sense to buy treasuries, corporate credit, S&P 500. And the zero rate policy took that frontier down. So that makes these assets richer because people bought them. We all invested in these assets. That made complete sense. Now, on top of that, easy took the risk to the left. You have the famous Fed put in the system. Any problem, the Fed comes to the rescue in cutting, injecting liquidity. So your risk on equities happened to be actually lower than it was back 13 years ago. Fantastic Goldilocks, really. You get better return, you get lower risk, and the efficient frontier goes down. And that's how it looked like just in 2020, around the COVID period. Treasuries depressed, corporate credit yields had come down because everybody bought them. Why would you go for foreign assets? There was no point. Why would you take the risk to go abroad when you had your central bank injecting liquidity like crazy and making your local assets a lot more attractive? So that is what happened. The problem is now we are there in 2020. Then you hike rates last year, so that completely changed the picture. So now again, if you are to assume that rates are there for some time, we're not just going to take them back down that easily, which we've hopefully convinced you that is the case. Central banks will not take them down easily. Then you're here on the left with a much higher dollar box, which is the financing rate on the left. And that means basically that you have your floating line a lot higher. On top of that, you're tightening quantitatively, taking the risk to the right back. You're just reversing the process of the years before that. That means that anything below that line makes no sense from an investment perspective. It's yielding less, it's riskier, and getting riskier. So at the very least, the first conclusion of all this is, you go cash. Why would you take any sort of risk back to the right of anything that yields less than cash? There's no point. And what happened, of course, last year was a big repricing. So all of these boxes moved up. So yields went up, corporate credit yields went up, the S&P fell, making it less overvalued, less rich, because investors sold all that. And this is now the efficient frontier we have in 2023. Now, it's telling you as well, the process is far from being over. There's a lot more to see. Again, if you agree with this idea that the dollar rate on the left is going to stay there or around these levels for some time, for years and not just months, then you've got a lot more to see here. So at the very least, if you don't know what's going to happen, you don't believe in the alternatives, you don't see anything attractive, return on bonds and equities is lower, risk is higher, you go cash, first thing. So a lot of investors did that and will continue to do that. And why not? You look at anything that is above that floating line. That might make sense. And of course, you sell all these. That's the process every single investor, local investors and foreign investors, are undertaking now. Many go cash. Some of them have started to look into alternatives and saying, yeah, I could blend that, instead of having my core allocation in the middle, I do a mix of cash and a bit of these riskier but higher yielding assets. Now, we think at H2O that you can build a portfolio with that cash and these riskier assets that is fairly diversified and offers a very substantial premium above cash. That's how our portfolios are built. Emerging markets, in a nutshell, on the left, the undervaluation of currencies. They've been doing really well for 3 years, yet they remain deeply undervalued, much lower than COVID levels. Yield-wise on the right, they yield 7% on average above cash. And here, we've excluded like sort of dodgy currencies. You don't have like the ones that are really on countries that have defaulted or are on the verge of default. So you really have sort of semi-core countries on the right, and you get your 7% above cash. You could add the fact that they benefit from the cycle a lot more than developed countries. You know, commodity prices are up, and the whole demand cycle we're in now. You could say as well that from a risk perspective, emerging markets have gotten less, on a relative basis at least, less risky than developed market. Many of these countries haven't spent even half of the money developed countries spent against COVID. So the balance sheet of these countries in many cases has improved, with current account balances that are now positive, with government deficits that are very much under control. So it's a bit like the world has reversed, where the US, the UK, and a number of countries look like emerging markets of the past, when emerging markets have look more like developed markets. So they tick pretty much all boxes: return, valuation, yield, the cycle. That makes complete sense in a portfolio. This is currencies. You have attractive bond markets as well, and some nice equity markets as well in this emerging market region. Now, you could say that also on equities. On equities, you have also some very attractive sectors. US market is rich. The innovation sector is facing challenges. Now, on equities, you have attractive sectors. Just not to bother you too much with these technical charts, just to say that here you've got the relative price of the three most growth sectors, the ones that have benefited the most from liquidity injections and low rates, against the opposite three, so the bottom three sectors, where on the bottom you find banks, European banks, you find car makers, and you find basic resources, and on the top side you find technology, you find industrials, and you find food and beverage. So you have there the three opposite sectors, just to illustrate that distance you had. The latter has really outperformed the former over the period. That makes sense, low rates. The problem is, if you look at the light blue line, profits are starting to go the other way now. So profits were coming down on the three bottom sectors. They're now coming up relative to the other three since COVID. That is the change of world we're talking about. They are better placed to cope with higher rates, better placed to cope with less liquidity than the top three sectors of the past 15 years.